Well, welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Sam Morris. He's a partner at Lone Star Capital, overseeing acquisitions, asset management, and investor relations. With over 20 years of experience in real estate, Sam has led acquisition and disposition teams on over $650 million in multifamily transactions. Before joining Lone Star Capital, Sam was the CEO of Sunset Capital, where he built a strong track record of sourcing and executing high-performing investments. And then prior to his real estate career, Sam spent 18 years as a corporate banker, involved in over $1 billion of real estate financing. Sam, thank you so much for being on the show today.
Charles, man, great to be here. Great to see you. Nice to meet you and to learn a little bit more about your audience.
Yeah, no, it's awesome. Thank you so much to come here and share your experience with us. I think we're going to get a lot of value out of this. So I touched on your professional background a little bit, but if you can tell us a little bit about yourself, both personally and professionally, prior to kind of founding Sunset Capital, and then we can kind of take it from there on what you guys are doing now at Lone Star.
Yeah, so I always tell people my favorite stat of all is I've been married 22 years, so I have 4 teenagers, and so real estate's easy. It's all subjective and relative, right? No, but I got started. My start was right out of college. I went into corporate banking, which at the time I didn't think was like the most sexy of things, because all I did all day, every day for really years was underwrite deals. And it's kind of funny the way it worked out, because it was the best education for me. Because by the time I was 25, say, I already had my mastery of knowing how to underwrite deals. And so if they say it takes 10,000 hours to master something, I became a master underwriter before I was, really old at this point. I was still a young man doing underwriting. And so I then worked my way up to lending on assets, specifically real estate assets. And I got introduced into multifamily. I started investing in multifamily in 2007. And it really was, I started to learn from the quantitative side, how these guys were making money, how syndicators were working the deals, what they were doing, and seeing the process with things, and seeing that in my young 20s. And so I took that leap to go ahead and invest into multifamily in my 20s. And so it was one of the things that got me really excited, because I learned to cut my teeth fairly early on some of these larger multifamily projects. And I didn't do what a lot of people do, which is that single family home or the duplex, triplex, whatever, and move up. I went straight into, I think the very first deal we did was a 100-unit apartment complex. And so everything was always go bigger, because I noticed the scale of things, the numbers just worked out a lot easier that way. And it was just as easy to do a larger 100-unit deal than it was to do a 5-unit or 10-unit deal. Matter of fact, it became easier from a management perspective to do those larger deals, because those larger deals could actually pay for the on-site staff you needed to run those type deals. And so I cut my teeth early and learned a lot of things that worked, and learned a lot of things that didn't work. And so, that's kind of the gray hairs that I got now, a couple decades later.
So yeah, that was one thing when I started getting financing on small commercial multifamily properties years and years ago. I realized that it is much easier to work with larger properties, because you had a lot of lenders that wouldn't even talk to you. And you had all these lenders that were interested. Hey, if you're back then, it's like if your loan size $1 million plus or whatever it might be, we have all these different other ones. If not, it's really like you're kind of calling local banks. You know what I mean? Which isn't a problem, and it's a great way of getting started. But what are those kind of things that you learned in that first investment? What were some of the things you took away that maybe you still utilize in your career today? Maybe some lessons that you learned, maybe they could be mistakes or things that you luckily did correctly.
Yeah. So the very first deal we did, I'll never forget it, because we closed it in August, and in September, I'm in Houston, Texas. We had a massive hurricane come through and actually just destroyed the property. I mean, it came through and literally destroyed the property. We went from legitimately 100% leased to 12% leased overnight.
Oh my God.
Yeah. And there was already a big plan in place that we were going to be doing a lot of rehab and deferred maintenance work and things of that nature. And so the insurance had to come in, though, and helped us significantly with that. And so I quickly learned everything you needed to learn about insurance and contractors and all those things that you would have to deal with when there's destruction to your property. But also in the state of Texas, when you're the landlord, you are required to provide housing for your residents. And so quickly learned, wow, we really have to be communicating a lot with our residents as well and make sure we find alternative spots for them, because some of these buildings are gone. I mean, there is no roof anymore. There is no more anything they can actually live in a habitable spot. And so we learned a lot through that. And this happened so early on in the very first deal. I mean, I literally thought, oh my gosh, we just lost everything because the buildings are destroyed. And what I quickly learned was having great contractors in place, understanding insurance and things like that, quickly was able to turn it around. And having knowledge in the finance world and understanding the lending, it turned out into being a great positive, because once the insurance came, paid for things, we were able to rebuild the project and actually bring the residents back or release the property up. We actually were able to lease it up for quite a bit more from what we were leasing it for, because everything was brand new. So residents that had left came back and they had brand new everything, appliances, flooring, HVAC, roofing, everything was brand new. And so they were willing to pay a little bit more, closer to what market rate would have been for that type of product. And it enabled us to go out and refinance the property. And when we were able to do that back in that time frame, we were able to refinance the property and pull the bulk amount, I think all of the cash that we had originally put in as investors within the first year of doing that. Now, it was an act of God that allowed us to do that, but it was something that I was hooked by. At that point, when I realized, wow, there are things that you can do and you can actually make a lot of money, pull all of our equity out of it. So we still own it, but we have no money in it. That was the light bulb moment for me to go, wow, this is something that really can be impactful, not just for the way that I want to invest, but for the residents that we're going to service in our local area.
Yeah, I was at a mastermind. Someone was explaining to me a similar story about a property that they owned in, I think it was Ohio, when a tornado came through, and, huge mess, everything like that. But yep, they were able to renovate them, and they were getting, back then, 7-10 years ago, whatever it was, $400 rent bumps, right, when they were getting it back. So for the investors, obviously, it's not the cleanest deal. However, it's a very high, return deal, a higher IRR than most deals, because of that, what they went through in really doing a full renovation versus your typical, I guess, value add renovation.
Correct. Yeah. And it's because, one, you're forced to, because the building's destroyed, but it's the things that you learn are, who are the appropriate contractors to have, making sure you really read and understand insurance and really have an understanding of what it's going to cover, what it's not going to cover, and making sure you understand the responsibilities you have as a landlord to your residents, and understanding all the contracts and things of that nature. And so it was an even greater education from just the straight quantitative that I'd had prior to that.
That's very interesting. One of those things is that it's not just having the contractor, as well as just being able to have that contractor be able to get the material. Because if it's anything like where we are down here in Southeast Florida, when it comes up and someone hears that there's a hurricane coming, all these supplies are gone. And then afterwards, if you were hit, I mean, it's just barren. You've got people coming from 18 hours away, driving, contractors coming in, materials. It's a mess. So it's really not just rebuilding it. It's actually getting the people and the materials there, which usually is something we don't even think about, because you think about just going down the street and picking up materials. So yeah, there's a lot of logistics there too. So, it seems like a lot of work, but it seems like you did really well for your investors on that first one.
No, we did. It was a very exciting one to be a part of.
So kind of fast forwarding to where we are today and what you're doing. So can you kind of explain a little bit about what's going on at Lone Star, kind of what you guys do, your current investment strategy there? I know you're really focused in Texas, so maybe what markets you guys are focusing on there as well?
Yeah. So at LSCRE, so I'm a partner at the firm. I have the great benefit and blessing of getting to oversee our acquisitions, our asset management, and our investor relations side of the business. And what we do is we're a larger, or we're a smaller company, but we typically buy larger properties. And so our buy box is in that, let's say, $30 to $70 million range. And because of that, it's going to put us into certain markets of Texas. And we only purchase in Texas. It's where we have all of our units. We have a little over 5,300 units here in the state of Texas right now. And because of the size of what we purchase, it's typically going to lead us straight into the primary markets, just because that's going to be where a lot of those higher value or higher dollar amounts are. And so we're predominantly in Houston. We're also in Dallas and San Antonio, and we have a couple other secondary tertiary markets that we're in that we'll probably be exiting in the years to come, and kind of focusing on what we call the Texas Triangle. And in that Texas Triangle, right, there's a significant amount of people, tons of migration. One of the reasons why we still love Texas is if you look at, almost all the KPIs, which are those key performance indicators, either Houston or Dallas are going to be number one or number two probably in the country. And that has to do with job growth, population growth, in-migration growth. And so we still have a lot of people moving to Texas. And so there's a lot of demand associated with housing. We absolutely had a lot of supply being delivered in the last few years, and we're starting now to see the bulk of that being burnt off. And so we still focus solely on Texas and in those primary markets. Our portfolio, like I said, consists of about 5,300 units right now. It's a little over $750 million in total value. And we're constantly out shopping the market. We do have a deal under contract right now. Last year, we only closed 2 deals. And so we're pretty picky for what we go after, but there's also an availability thing. And so we were made the bridesmaid on a few deals, no doubt, last year, but we're still out there hunting each and every day for those deals that will be beneficial to our investor base and the growth of our company.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So one of the big things when you hear Texas, obviously, is taxes. Most people, when they're thinking of Florida, they're thinking insurance. But obviously in Houston, insurance is a big thing, like we were talking about in your first deal. But as these being like really 2 large expense items, what strategies can large syndicators employ to really mitigate them?
Yeah, and I would actually tell you you don't even have to be large, but those are uncontrollables, those 2 expense line items that you just mentioned, and they're larger for us, obviously in Florida and in Texas, right? Because we have large property taxes here, and we have significant insurance as well. Insurance has actually been kind of one of those better things to be a part of the last few years here, because we've actually been getting pretty significant reductions, and a large portion of that is we haven't had a lot of weather events that have actually occurred to impact the global for it. And we're part of a master policy. So all of our insurance is under one policy, and we spread the risk amongst all of our assets when we do that. And because of that, we've gotten some pretty significant reductions the last 2 years. And we actually expect another reduction this year in 2026. When I say significant, I mean double-digit type reductions for insurance. And so it's actually been quite beneficial. And one of the things that occurs, or one of the reasons that occurs, is you actually are starting to see more insurers come into the state of Texas. So they're starting to see that there's some value associated with that. And when you have that, it creates a little bit more competition. And so premiums will go down associated with it. That being said, it's still not at a level that it was, call it prior to 2020 or something of that nature, because of the weather events that we have had and the losses sustained by some of those insurance companies. But we're now getting back to that level where that pendulum's coming back around a little bit, and we're starting to see reductions of significance. And so insurance has actually been one of those things that's actually kind of been a bright star for us, because as an uncontrollable expense and the fact that it's being reduced, it's actually been quite helpful for us with the existing portfolio we have and with some of the things that we're underwriting. Taxes is a little different. What a lot of people don't realize about at least the state of Texas and taxes is that you have to fight them every year. So they get reassessed every single year. You get your tax value every single year, and there's no cap, meaning it's not like they can go, all right, we, as a state, we've decided we're only going to be able to go up, say 10%, and that's the max we'd be able to increase. No, you can have 100% increases in your tax. And that's just the way that it works with a lot of counties. And you got to go and effectively hire a group, which we always do, to go fight the taxes on your behalf for valuations that you then come to agreement with. And it is something that we consistently do for all of our properties. However, one of the strategies that we've employed, which is a little unique, is we've been bringing in a tax abatement strategy over the last few years to our properties. And this answers a few different things. One, it helps us control a lot of an uncontrollable, which is the tax values of the property. But two, it also answers an affordability issue that we have with our state. And so what we do is we take about half the units in general, working with the county in jurisdiction to bring an affordability aspect, and we call it affordable little a, not big A, to the property, so that people that live, work, and play in that area that may not otherwise be able to afford our units are actually able to afford our units and actually live in those. And the benefit for the property is that we get an abatement for the taxes associated with that property.
Yeah, that's a very powerful thing. We have a property right now, a deal in Dallas, and that was one of the taxes were one thing that we were like 20% off on, and we're fighting it right now, but it was just like for a pro forma. And it was, it's something that, you got to fight them every year. And we are actually employing something similar to what you're doing. We're actually in the process of getting a application approval for it to hopefully bring ours into more of an affordable housing sector to save on those property taxes, which is kind of one of the ways I've heard from a number of different operators down there.
Yeah, we've done it now 14 times with our properties. And so we have a fairly, a good understanding of how it works. However, that being said, last year, so in May of 25, the state actually started changing some rules associated with it in the PFC and HFC world. And so we haven't gone back to that, into those particular stripes of structures, and probably won't until, call it, let's say, well into 2027, when we have a better understanding of how that bill is actually going to be implemented. And so that bill gets implemented January of 27. And so until that legislative risk is really understood, we're probably not going to be putting properties into that type of structure.
Interesting. So as your firm with Lone Star, you guys controlling full on the investment, pretty much the whole vertical, because you're handling everything in-house. What would you say some of the benefits of vertical integration, keeping your construction management and property management in-house, and not just, you have some that people will say, well, we have our property management in-house or we use third party, but then it's another step to have your construction management and your construction in-house. What do you feel, other than just the full control, which is usually what I hear, is there any other huge benefits? I imagine control of the cost is probably one of the big ones.
Yeah, it's fairly dramatic. I was talking to some investors yesterday because of the property that we're acquiring. We need some significant roof work done, and actually full-on replacements for probably several of the buildings. And we have examples where our in-house construction management's able to do it for anywhere between a third to a half the cost of what we would have to hire out third-party roofing contractors to come out and do. And it's because we have the expertise in-house. So there's pluses and minuses to it. From an investor standpoint, it's almost all pluses. From a minus standpoint is, we have about, call it 220 employees in our company. The overwhelming majority of those are our on-site staff. So those are the people that are helping us run our properties, right? You can be much smaller as a group and third party out property management or third party out construction management and things like that nature. But there's a couple things that you're going to give up as a company if you do that. One is the cost control, like you just mentioned. Another one would be timing, right? We actually control the timeline associated with this, whereas we're at the behest of another group if they come in to actually do things. And then the biggest one I would say is actually quality. So we can control the quality of the work when we do that as well. And so it's, if it's one of those things where we paid a contractor to do it and the contractor wasn't as great as what we had hoped for, and the quality came in not what we would want or not what we would expect, right? When we do that in-house, we're able to control all those aspects of it. So a fully vertically integrated company, which we are, we have property management in-house, we have asset management in-house, and we have construction management in-house. Gives great benefits to our investor, our ownership, for those things, right? We're able to control the quality, the timeline, and the cost associated with all the aspects of running the property.
Yeah, that's a huge benefit. The whole timeline was something I wasn't even thinking of. One of the things that when we would be working with like third party construction companies renovating units, and you go in and it's not 100% ready, and it's just like you're going back and forth. So having your ability of having that all on site and knowing that something's 100% done at the right time, imagine it cuts down on your turns too.
Considerably, makes it cheaper. It's all cheaper because of that, right? Because if I can turn a unit that much faster and have it ready for the on-site team to lease, days off a market is a true cost to us. And so if they're able to go, if we can give the on-site team the confidence to go lease as soon as the thing comes off, because we have the teams ready to come in here and fix everything, do everything to the quality and standard and the expectations of that on-site team, well, that changes a lot of things. And that means you make more money, right? And so it's tremendous. And, when you were talking about hurricanes and things like that earlier, when you have those people in-house, right? And you're talking about sourcing materials and things like that, which we've gone through all this stuff before. We had a major freeze event that occurred, several years ago, where I was looking for shark bite fittings because of all the pipe breaks that we had, and we couldn't find them anywhere in Texas, because it was a major freeze event that had occurred here. And so we were sourcing material from outside the state to come in. But you had the on-site teams that were able to come in and fix things faster than what our competitors were, meaning I got back up and running and I had units ready to lease for people that were impacted to come lease with us prior to either staying in the bad situation they were in or trying to wait it out to figure out where they can go live. Well, we offered that to them. It was one of those things that are beneficial. We were the first one to the finish line, so we win.
Yeah, that's a very powerful ability of adding that into your arsenal of what you're able to do and offer to your properties and to your investors, because many different syndicators don't have the ability of kind of going in and being able to kind of pull that card. You mentioned before starting in investment banking, doing a lot of underwriting when you were younger. And I think it's one thing that maybe some passive investors don't understand, maybe even active investors, the number of deals you're looking at before you're purchasing one. And as a general partner, you're probably reviewing hundreds of deals before purchasing. And, there's fees like acquisition fees that are used to compensate the syndicator for pretty much all that effort over all those months, maybe years of doing that and buying those 2 deals like you did in 2025. But how does a passive investor know if a deal is really fee heavy or if the fees are really appropriate for the deal?
Yeah. So for starters, right, everything needs to be disclosed. If a general partner is not disclosing all the fees to you, it's a major red flag, right? And so it's not something that you shouldn't be upfront about, right? So for our deals, it's real simple. We charge a 2% acquisition fee on the deal, meaning 2% of the purchase price we are charging the partnership as a fee for us, and it's for pursuit cost. It's for the risk associated with the deal. A lot of times it's for signing on the loan or things of that nature. And so you'll be able to see the fee structure associated with it. But there are a lot of fees that can be built into PPMs that you need to look for. We disclose what we charge for property management, which we charge 3% of the gross revenue for property management. That's actually very standard in the industry. We charge 2% for asset management on the gross revenue. That's a fee that does get changed around a little bit, where you'll see some syndicators charging it based upon the amount of dollars that are raised. And that can be a very different number to have an understanding of what that looks like. On construction management, meaning if we're going to go oversee a big project, let's just say we have a $1 million project that we're going to be doing at the property when we acquire it. We got $1 million worth of work to do. Part of the fee for that $1 million is going to be a construction management fee, and that's going to be anywhere between 5 and 10% of the actual budget that what we're going to be spending that goes to pay for a lot of that construction management that we do. You'll see people put in exit fees, meaning once we sell the deal, we're going to charge you another 1% to sell the deal. But there are a ton of fees that are different, that are out there that different people can charge. And each group's going to be a little bit different based upon how they are built and structured. For us, we typically charge a 2% acquisition fee. We're 3% for property management and 2% for asset management. And that's our fees. It's pretty simple. And so for us, we look to make our money, or we're more incentivized on the back end, which we feel keeps us more aligned with our investor base.
Yeah, no, you'll have some investors that understand that, especially ones that have done deals before and they understand the extent. I think when I've had calls with past investors or potential past investors, and there's a lot of talk about the fee structure, which ours is very similar, if not identical to yours. It's one of those things where it's the amount of work. It's not really you have to really educate, I think, that investor on the amount of work that goes into this. And when you're reviewing it and you have that construction management fee and stuff, project management fee, there's a lot of work that goes to make sure that those units are turned correctly, or that roofs are on correctly, or whatever it is that has to be done 100% because it's a major part of your business plan. So,
yeah, even before that, though, even before all of that, the pursuit costs and the risk dollars that we put up ahead of time, a lot of people don't really understand. So we're like, for instance, we're putting a deal under contract right now. It's a $61.5 million deal. So 61 million bucks, right? As part of the contract, they want us to put money up hard, right? Meaning I have to put risk dollars in place. Whether we close or not, this money is now up to risk. And so I've got to put a certain dollar amount in addition to dollars that we're going to have to escrow for a deposit for the deal. And so what it is the seller is sitting there going, I want to know that you guys are really going to close. So you're going to need to put up a certain dollar amount. That can be anywhere between 1 to 2% of the purchase price. So keep in mind, that can be anywhere between $600,000 to $1.2 million of dollars we have to come up with ahead of time to pay at risk for the deal. In addition to that, as you start moving through the process, there's deposits that I got to put with our lender to get going associated with that. And we haven't even rate locked yet. When you do that, there's another big dollar amount that you're going to have to put down associated with that. So there's a lot of dollars that get outlaid just from a risk standpoint up front. In addition to that, I have people that help me, go find and source the deals, and they're flying in to come look at the deals, and we're all doing things. And then we're having DD, our due diligence, that we're bringing people to the property. We're doing lease file audits. We're actually walking each one of the units, and all this stuff is done before we put investor capital at risk. And so it could be on something like that we have millions of dollars into this deal, right? And our fee associated with it is commensurate with the risk that we're taking when we put all these things in, because we're also chasing deals all throughout the year and underwriting deals. And, it's really weird, but our employees like to get paid every 2 weeks. I mean, they're a little, selfish that way but that's how it is, right? That's what we need to do to be able to provide these great opportunities to our investors.
Wow. So in addition to, putting down that AMD, the earnest money deposit, that's in your situation here going hard initially, so you're not getting it back if you don't close. I mean, you're probably also laying out 6 figures in different fees between all the due diligence, inspections, between all the work that's done for going in, walking every unit, all the reporting, everything like that. So, I mean, it's a considerable investment.
Yeah, at this level, I mean, we call it putting on your big boy pants, because you're going to have to put some money at risk.
When you're hearing like preferred equity, it's one of those things that we didn't really hear too much, I guess, when we start syndicating deals, I guess in like 2018, 2019, something like this, we weren't really utilizing preferred equity. And it's something that really started around 2022. I started seeing 21, 2022, people started utilizing this because the prices started going up, and to get the returns, they were bringing in a private equity firm, usually with preferred equity. Now, as preferred equity is really sometimes a layer in some of these capital stacks, and it might confuse some passive investors. Can you explain a little bit about how preferred equity can effectively be utilized in the deal?
Yeah, so it's different ways that we're seeing it being done in the timeframes that you're talking about, right? So there are people that use preferred equity at the front end, and that preferred equity was typically utilized like a loan, meaning if you have a capital stack, if you can envision like 3 sections, right? The common equity would have been up top, right? As the last piece to get paid, that preferred equity would come in between that and the senior loan. And the preferred equity, typically, the reason why they call it preferred, would get paid prior to the common equity that a lot of people have utilized. And they did that because they were able to go, all right, well, hey, the common equity, to get the returns that I need to bring in a preferred sliver that I'm going to pay, pick a number, 12% to, right? And that's all they're ever going to make. They're not going to make any of the upside of the property, but my common equity is, but I need to get to better leverage associated with it to be able to get to those returns of common equity. Where you've been seeing it a lot more in the last few years is what we call either cash in refis, or people utilizing it to fully, to fund their deals, meaning, hey, we need some additional equity into our deal to, ride out this situation we're in, or because we've had costs like insurance go up and the property itself needs more dollars. And so they're bringing in preferred equity, right, to come in. It supersedes the common equity, and they're going to pay them effectively a rate associated with it. People are also utilizing it to right size their loans, meaning I did a loan, say in 2022, it was a floating rate deal when I did it, and I was paying 3% at the time, and it was great. Well, interest rates shot up, and I'm now paying 7% on it. My cash flow is suffering because of it, and I need to go and refinance my deal. Well, when I took it to the lender to go refinance the deal, they said, well, hey, this is fine. We're willing to do it. We can cut your rate down to 5.5%. However, we're not going to be able to lend you what you have on the deal. Meaning we need to be at an appropriate loan to value. We feel your value is impacted, which a lot of real estate has been impacted, and the values are not quite where we were in 2022. And so to do that, what they've done is what they call a cash in refi, and they're bringing in preferred equity to cover that gap for it. And so the way that a lot of people are selling it is, hey, we're bringing in equity, but all we're doing is paying down our first debt. But what a lot of people don't realize is that preferred equity it typically supersedes the common equity stack, meaning it's going to get paid first, its dollars plus its return prior to anything getting paid to common. And so that's where you've been seeing a lot more of that. It'll be called a lot of different things, right? But that's effectively what you're asking.
Yeah. I think some of the investors don't understand 100% how it sits behind really that, or they are sitting behind that preferred equity as common equity investors. And it might not be something that many syndicators explain to them fully about how they're doing it or how they're really capitalizing the deal and what that really means to really, when you're going to retail investors, you're getting common equity from them.
Correct. And a lot of people don't realize in most PPMs, which is the agreement that you sign when you initially do the deal, it's built into that from the beginning, meaning the GP has probably already got it pre-approved that he or she can bring in preferred equity throughout the life of the ownership.
So as we're kind of wrapping up here, what would you say over, reviewing, I would say maybe thousands of deals over these last couple of decades, being involved with hundreds of millions of dollars worth of multifamily deals, what would you say are some common mistakes you would see real estate investors, maybe multifamily real estate investors making?
Yeah. I have seen a great property turn into a mediocre one because of bad management. I have seen a mediocre property turn into a good property because of management. And so to me, I always tell people the most important person in the entire project is the person that's sitting in the chair on site, because that's the person that's executing your business plan. That's the person that's running, in our case, a multi-million-dollar business. I mean, we're giving a lot of trust, and that's the person that probably needs the most amount of support on an ongoing basis, right? I really look at 3 people when we're doing a deal and the impacts associated with it. One is the resident, right? The person that's actually going to be living on site and paying for the rent, paying your ability to be able to do the things that you're going to say you're going to do, right? Willing to pay for that business plan that you're putting together. The second one is that on-site manager. I want to make sure that he or she is supported the way they need to, that they have the capability of doing what it is, and that they have the staff around them to help them all succeed. And the third one is the investor, right? The LP that's in the deal with us. I know if I can take care of those 3 people, right, the deal will take care of itself. Because if we're taking care of the investor and communicating with them and able to respond and do what we said we're going to do, right, they're happy. If we're able to take care of the on-site manager and the staff associated with it, right, they're going to be able to take care of the residents who, if they're happy, they're going to be renewing, and we're going to end up making a lot of money. So it's a pretty easy system. That's why I say it's not really that difficult. It just takes a long time to do, and the processes have to be in place to be able to execute that way.
Well, Sam, thank you so much for coming on today. How can our listeners learn more about you and your business?
Yeah, so real simple. Our website is lscre.com. And so if you just join, hop online, get there. We'd love to learn more about you. You can join our platform. We put out a lot of content. We typically do about two newsletters every month. And we also are, actively seeking new deals and new investors.
Okay. Well, thank you so much. We'll put those links into the show notes, and look forward to connecting with you here in the near future.
All right. Thanks, Charles.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.